Okay, with the savings account, obviously you're not canceling interest. You are gaining some interest, but it doesn't work as good. But we're going to focus on the line of credit here for a second. Another great reason why to use a home equity line of credit is it is tax deductible. Interest that is spent there, obviously consult your accountant for what can be deducted there, but there are the possibilities of tax deductions because it is a loan against your primary home. Okay, the other great feature of a home equity line of credit is it works just like a checking account. You can put money in, you can draw money out, you can make payments out of it, so on and so forth. And another huge advantage is it creates a safety net. A safety net is a huge thing, especially with the economy that it is right now. If you get a line of credit, and say you have a line of credit of, say, $15,000, $30,000, $20,000, $25,000. We're going to say $25,000 for conversation's sake here. Okay, if you get a line of credit for $25,000, the software is not going to have you max this thing out. The software will keep the line of credit at a low balance at all times, obviously depending on interest rates and payments and so on and so forth, and how much expenses you have during the month. But the line of credit acts as a safety net, so you can be very aggressive with your mortgage acceleration plan. If the line of credit balance only gets up to $10,000 to $12,000 at any given time during the year, that means that you always have $10,000 to $12,000 in which you can draw on from your line of credit. Now, if you lose your job, if your client, goes through, they're not getting enough hours of work, the employment ratios keep going up and up throughout the last few months here, it acts as a safety net so that you can always have access to money drawing from there. Now, obviously, home equities are going down. Some home equity lines are getting cut, so on and so forth. There's just some crazy things going out there in the market. But the home equity line of credit is the ideal account to have open to run the software through. Okay, so if we have a line of credit, come in here and simply name the line of credit, whatever you're going to name it. Put the bank's name I would put here, name it HELOC, whatever you want to do. Just simply come into here. We're going to say it's a Chase home equity line of credit. If it's a personal line of credit, name it whatever you want to name that account. It just helps you understand what it is exactly. If it's a line of credit, obviously we're clicking on line of credit. We're going to put the initial line of credit balance. Obviously, if some people pay you right now for the software, you can put the balance in there if they pay you out of their line of credit, and then the software will move forward attacking that, getting it paid off. Put in the line of credit interest rate. Is it 8.5? Is it 7.5? Lines of credits are actually really good interest rates right now because the Fed has cut the rate so much in the last little while. Okay, so we're going to say you charge them $3,000 for the software, 7% interest rate. They have a $25,000 line of credit. Save that information. There you go. You can always review it. It's always going to be right here in front of you. It's a line of credit. Here's the name of the line of credit. Here's the balance of it, your interest rate, and your limit. Okay? If any of this information changes, if you need to update it, just simply come over here to edit and change the information. Okay, so that's using your acceleration account information as a line of credit. Okay, now what if we want to do it as a savings account or a checking account? Simply come down here to interest bearing and select on it. Now you'll notice these fields are going to change once I select it. Okay, now it's going to ask me what is my initial balance in the savings account, in the checking account as of today. Okay, so put in what the savings account balance is. What is the interest rate? What is the rate of return you're getting on it? Well, maybe they're getting a whopping 1.25%. When you're putting in interest rates, don't put in the decimal and then figuring it out. Just basically put it in. If it's 1%, you just put in a 1. If it's 1/4%, then obviously you're going to put in 0.25. Some people may think it's 0.25 for a 25%, so on and so forth. Just put it in right here. So if it's 1.5%, we're going to put in 1.5. Rainy day. What is this rainy day? The rainy day is so that you tell the software because I'm using an interest-bearing account, a savings account, a checking account, whatever it may be, I never want my line of credit or my account to go below this amount, okay? Some people just want a safety net, a rainy day fund in there, which they don't have with the home equity line of credit, okay? So we'll name this one as a Chase savings account. Okay, save the information. Now it's going to run that with this information that we've been input there. Okay, the advantages of the savings account obviously is you can sell the program to anyone. Anyone can get on the software. They don't have to get a home equity line of credit opened up, which are very hard to come by right now for those of you in the mortgage industry who understand this. You know, they're very hard to come by because people's home values have went down in value, for one, and then the lending requirements have gotten a lot higher. They don't let you go up to higher percentages, so on and so forth in there. Okay, let's move through here. So any questions on that, go ahead and post them in the questions section. Before we move on here, I only see one question from Deanna, and Deanna will actually answer that here in just a bit. So hold tight on that. Okay. All right. Moving on here. So we understand the line of credit. We understand the savings account, which one we're going to use here. Put that information into here. Now, the savings account isn't going to be as aggressive as the line of credit is, because with you using a savings account, if the software is telling you to max everything out and pay this, pay this, pay this, and just keeping it down there at all times without you proving to it that you can make these payments over time, so on and so forth. Just like with the line of credit, it can do that because with a buffer zone that you can always be drawn on. Now, with a savings account, you're not going to see as many lump sums in the very beginning, but they will come in just a moment of time. Okay, so the mortgage. Let's move on to the mortgage. Okay, with the mortgage, it's just simply inputting the information. Come to the mortgage section, click on edit, make sure you name it, get specific with it. Who's their mortgage with? Is it with Wells Fargo? Is it with Chase Bank? Is it with Citi? Is it with Countrywide? Whoever it may be. Put in the original loan amount, okay? If you have to get out their HUDs, their settlement statements from the time when they closed on their loan, the more specific you can get, the better, or just have them tell you exactly what it was. Okay, so we'll say it was $245,000. What was the start date of the month? Okay, this is the closing date when everything closed. It's pretty easy to tell on a settlement statement. Some people, they may associate when it closed as to when they made their first payment. I mean, if you close a loan today in November, you're not going to pay a first payment until January. Try and get the start month of when they actually closed. If you're within a couple months, you're going to be able to obviously update your balances when you reconcile, and so it's not that big of a deal if they can get it within a month or so. Okay, so we'll say they started the loan in June. The year, obviously, that's pretty simple. What year did it start? We'll say it was 2007. What's the current balance? Okay, current balance is easy to figure out by just simply looking on the last payment stub that they have. It will show on there what their last balance amount was. Just put that information in there. Okay, how long is the term? Is it a 15-year loan? Is it a 20-year loan? Is it a 30-year loan? So on and so forth. We don't want you to put how much time they have remaining. We want you to put what the original term balance was. See, what it's doing is it's figuring out the amortization table for this loan that has been created. What it's doing is it's taking into consideration if this was the original loan amount, if this was the interest rate, and if this was the term. What it's now doing is it's going to know exactly what your principal and interest payment is. Then you tell it what your payment you pay is every month. Say it's $2,500. Not $25,000. $250,000 here. Okay, what the software is going to now be able to do is run a calculation of if the original loan amount was $245,000